All right, all right. This is a Q&A. The floor is open for you all to ask questions. Like I never, obviously I say, never prepare anything for these. So I just want to give you guys as much time as possible. Okay, so OI is open interest. When you go to the options chain and you look at a set of contracts, you'll see it says open interest and volume. And OI is just open interest. It's just how many open contracts there are. So like volume is how many contracts have exchanged hands between seller, buyer, seller. If you sell a contract to someone, that's one volume. Open interest is like if you bought a contract, that counts as one volume, but then you're still holding that contract. That's like one contract that you have open. That's the open interest. So like if there's really low open interest, it just means that there's not many people with those contracts. There's going to be massive spreads, but we could also get stuck in trades just because no one would want to buy our contracts that we have to sell. So these are the contracts we were trading yesterday. And you can see in the top right, B and A, that's just bid and ask. So that's the spread. And then these are the prices of the contracts. So you can see the volume, bid, price, ask. Well, under the volume, you can see these blue bars. These are all the orders. So you can see there's 11 at the 65. So you can watch people come in. And when I place the call out, I see that, obviously a massive influx within whatever specific contract I'm trading and I called out. Do you always let your take profit close the trade, or do you ever manually take profit? I always manually exit the trade, right? I never have an order that gets executed automatically. I always go and I log in and I manually exit all of the trades that I take. How late is too late to enter a trade? Well, it really just depends on what happens and how much that stock has moved and what the scenario of the specific trade looks like, right? If it was like 340 on at any given day and we're in a trade, then that's too late to enter the trade because we close the trade in 15 minutes. But if its trade comes through at 10 o'clock and it's 10:30 and we haven't hit our stop loss, we haven't hit our take profit, and it's relatively the same price I bought for, then it's probably still a good buy. But it's totally up to you. There's no parameters or rules around what's too late to take a call out, or if it's too late. It really just depends on the trade scenario specifically and what your intentions are getting in. If you're fine paying a little bit more or paying a little bit less, right? Kind of could go either way. If someone gets in the trade but sells early for gains, does it affect everyone that trades? No. So these stocks we trade, these are massive stocks. This isn't penny trading. This is not penny stocks. This is not crypto. This is not meme coins. The market's so huge. There's billions of dollars in these stocks we're trading, and we're not doing anything to move them. I mean, what influences the price of a contract is going to be the actual share price of the stock, and if the stock's going up or down in value, and everyone's trading around that, right? So technically, yeah, you could get a better fill than I would if you got in a little later because the stock went up or down, whatever the case is. It's pretty cool, when you really think about what's going on and that this is a marketplace. Whenever you buy contracts, you're buying them from someone that's selling them to you, right? There's always someone on the other end of that transaction. And one end of that transaction is going to be a losing end of that transaction, right? Because whenever you get out of a trade, you're either making or losing money. And that just shows you how there's this competitive nature inherently built into the market. It's you versus yourself, it's you versus the market, it's you versus other people, you versus institutions, you versus retail. There's a lot that goes into it, right? How do strategies differ when there's so much chop in the market like we've been seeing lately? I mean, based off of market conditions, some strategies are going to hold up better, some worse. I mean, a lot of traders are going to be trend traders where they're only going to capitalize on trend and make money trading trend, and then they'll lose money when the trend shifts. But I mean, the way I trade, we're able to inversely trade either direction and shift momentums. Trading against the trend is really how I'm making money, doing the opposite. But it depends on the strategy. It depends on, the style of trading. I mean, there's a lot of variables that go into that, but some strategies are going to do way better. Some styles of trading are going to do way better in certain market scenarios. I'm currently in a swing for tomorrow on Nike. Their earnings report is this evening, and it's expected to have a decline of 39%, have a minimal stop loss of less than 2%. My portfolio, so I'm interested to see how it goes. You should not be swing trading through an earnings call or ever holding a position through an earnings call. Why? Because even if you're right and the market opens tomorrow and you bet correctly, those contracts are so overpriced right now because there's already been an influx or increase in the price behind the contracts. The premium's already gone up because of the implied volatility. So you just overpaid a lot for those contracts, and tomorrow, even if you're right and the market opens, you'll probably break even or even lose money, even if you're right. That's the best case. You have no control over what's gonna happen. It's just gambling. So just be careful. I didn't mean to just totally like flame you, and like, I hope you aren't offended by what I said. I hope you just learned something. You can do whatever you want. I mean, that's just from my experience trading. It's what I've seen. How much did you use to trade when you first started trading? I started out with a couple $100, $1,000, I think, and then slowly kind of grew my account. I think when I first started trading, it was crypto, and I was finding a lot more consistency just scalping essentially. But then trading options, I started out with a $10,000 account, and I blew up that $10,000 account within, I think, a month or two. What caused you to lose it all? Well, I had no idea, first, what options were, second, what risk management was, and third, I wanted to get rich overnight, so I was putting my whole account on trades. So learning about not only how volatile and risky options are and how to put yourself, even when trading a volatile instrument like options, how to decrease that volatility and risk, buying further out expiration contracts, further in the money, right? Buying, an equivalent, but relative to how much you're trading with, a realistic position size, 3, 4, 5, maybe 10, 15% max, instead of putting 80% of your account on one trade. Expiring, most of the trades I probably took were same week expiration because they're cheap. And you think, oh, let's buy cheap contracts because I have a small account and they'll go up more. So don't do that. Is it better for you to trade on Eastern time rather than Pacific Standard Time? Yeah, I mean, I definitely don't like getting up early, so Eastern is much, much better. Whew, yeah, trading in California when I was in LA was not fun getting up at 5. So I definitely prefer trading Eastern. Looks like we got to everyone's questions. Thank you for tuning in.